All right, people. So welcome to Jumbo IS and welcome to our current affairs lecture series. Now, today we are going to cover 1 week's economics current affairs. So all the important news items that happened in the past week with respect to the topic of economics would be covered in today's lecture, right? So pay close attention. And mind you, just watching this lecture would be job half done because just after watching it, you need to revise it as well. Otherwise, you'll quickly forget these current affairs. Trust me on this. So if you really want to retain these current affairs, at least till your exams, well, you need to consolidate them in your memory just after watching this lecture. And this can be done by revising it. Now, the notes for this lecture shall be shared on our Telegram channel, and the link to our Telegram channel is provided in the comment section just below this video. So do check that out and do the necessary revision. All right, then. Enough of the introduction. Let's straight away dive into the lecture. But first, let's take a look at the list of topics that we shall cover today. So let's begin. So current affairs, economics, June, part 3. Every month has 4 weeks and we are covering 1 week's current affairs. So June would have 4 parts of economics. Now, as far as part 3 is concerned, let's take a look at the topics. So these are the topics. And mind you, this time around, and this is going to be a unique time, where all the 4 topics are related to each other. Okay, they are interrelated, all 4 topics. Number 1 is inflation. CPI inflation hits a 16-month high. And this is but natural because of the crisis in West Asia. So we'll talk about this. Then we'll talk about external sector and exchange rate management. You all know that rupee vis-a-vis dollar has been in a free fall situation. But now recently we have seen some good news with respect to the arrest in decline of rupee. Possibly government has taken some remedial steps because of which this decline is not continuing, right? So what were those steps? What was the exchange rate management policy followed by RBI and the government? We'll talk about this. Then again, to stabilize Indian economy, government took certain steps with respect to foreign investments, and that is capital gain tax exemption for government securities, so that more and more foreign investors invest in government securities. And in the end, we'll talk about all the steps taken by government of India to shield India's economy. These are known as strategic macro shields. This topic is extremely important for both prelims as well as mains. So do pay close attention as far as this 4th topic is concerned. Okay, so these are the 4 news items that we shall zero in our attention on. So let's start discussing them one by one. Starting with topic number 1, and that is CPI inflation hits a 16-month high. You know, a few months back, well, inflation was at its record low. Because of the continuation of crisis in West Asia, Iran, Israel, America, blockage of Strait of Hormuz, all these factors basically played a role, and that led to rise in energy prices. Supply-led constraints were there. Because of this, inflation is again a big threat. And the recent data points out that inflation has reached a 16-month high. After passing through a 12 or 14-month low, now it is at a 16-month high. Now, what are the factors behind this? And what impact this is going to have on India's economy? Let's discuss this entire issue. Okay? So CPI inflation hits a 16-month high. Now, what was the context basically? So CPI, especially, you should know this, that we calculate consumer price index, and consumer price index is a measure of inflation. We calculate it for rural India, we calculate it for urban India, and then there is CPI combined. Okay, this CPI combined is known as headline inflation, or let's just call it for simplicity, official inflation. Okay, so this is headline inflation, the main inflation that everyone looks at. Now, this headline inflation, or all 3 measures, CPI, rural, urban, and combined, they are released by National Statistical Office, which is under Ministry of Statistics and Program Implementation. Now, they came out with a data point, and they have said that CPI combined has reached a 16-month high of 3.93. Though this is still low, but the trajectory is upwards. Basically, we are comfortable if the inflation is 4%. But this is rising continuously. Next month, it is going to be 5%. If we do not do anything. That is why we have pressed the panic button. Okay. Now, the acceleration represents the fastest pace of price escalation since January and leaves headline inflation sitting just 0.0% shy of RBI's strict 4% median. So RBI targets 4%. Now inflation is 3.93%, which means it is just 0.07% away from RBI's target. And if it crosses beyond 4%, well, RBI will press the panic button. It has already done so. Now, What is the breakdown of all of this? Okay, so CPI is at 3.93%. Now, if we divide CPI, or we look at inflation figures based on rural and urban. So rural inflation is higher than urban inflation, as you can see over here. That means villages are suffering more. Okay, this is a problematic statement. Then this is if we divide inflation as per geography, rural and urban. If we divide inflation component wise, okay, for example, food inflation is very high, then there is this thing called core inflation. You should know this. What is core inflation? Core inflation is non-food, non-fuel inflation. So if we remove inflation from food items, fuel items, and we check inflation in other commodities, that is what core inflation is. Now, up till now, core inflation was really stable, but core inflation has also risen. It has accelerated, plus food inflation has also accelerated. Now, let me break this down for you if you have forgotten this, though I'm sure, most of you are already familiar with this. Okay. Inflation is caused by basically the balance between demand and supply. Okay. Whenever demand exceeds supply, there is inflation. Now, there are two ways through which this can happen. If demand stays constant but supply falls, okay, then inflation will happen. This would be called supply-led inflation or supply shock inflation or cost push also. But if supply stays constant and demand rises upwards, then that is demand pull inflation. Okay. Now remember this one fact. Core inflation is generally the main factor behind core inflation is demand pull. And if we talk about food and also fuel, in case of food and fuel, the inflation generally happens because of supply shock. Because demand is more or less similar. But when supply drops, for example, because of Strait of Hormuz, we are not getting enough supply of crude oil. Supply falls, right? So remember this one thing, because this can be asked in your prelims examination. Core inflation is generally driven by demand pull factors, and food and fuel are generally driven by supply factors. Just remember this fact. Now, if both are rising, then that means the visible supply shock factors are definitely there because of Strait of Hormuz and all. But now we are also witnessing demand pull factors as well because core inflation is rising. You understand? Okay. Now, regional state-wise divergence. What is happening in different regions of India? So among states with a population exceeding 50 lakhs, significant variance was observed. Okay, highlighting uneven problems. So states with very high inflation, Telangana, Tamil Nadu, Andhra Pradesh, southern states are witnessing very high inflation. Okay, as compared to northern states. This demonstrates that despite centralized monetary action, despite centralized policy with respect to inflation, RBI manages inflation and RBI takes a decision for the entire country. Still, we are witnessing divergence in different regions. Localized logistics and regional supply blockages play an asymmetric role in driving up everyday consumer prices. Despite RBI taking a centralized action, still we are witnessing state-wise variation because there are local factors involved. And they are generally local supply factors that are involved. Okay. Now, what have been the drivers of this inflation, this 16-month high inflation? What is driving this up? So, well, these are those factors. First of all, food inflation. We are witnessing heavy volatility in food inflation, especially with respect to tomato. Tomato saw record inflation numbers. And cereals, rice, wheat, the staple crops. These are witnessing very high levels of inflation. Then, fuel inflation is there. And why is fuel inflation happening? We all know because of crude oil. Crude oil has reached $110 per barrel. This is really high. From $70 or even $60 per barrel, the fuel prices, crude oil prices have doubled. And why is this happening? Because of supply shock. The supply has fallen. And why is there shortage of supply? Because of the blockade in Strait of Hormuz, and we get most of our energy supplies from Strait of Hormuz. You understand this, right? So this is happening. What do you mean by logistics? Well, logistics is transportation, storage, Now, even transportation, the entire logistics services have become expensive because fuel costs have increased. So everything is becoming expensive. Okay. Now, why is there very high inflation with respect to, I mean, we import everything, not everything, but we import a lot of things. Now, imported inflation is there. What is imported inflation? Well, whatever we import has become expensive. Now, imported inflation is happening because of various factors, but one factor is decline in rupee. Because rupee is declining vis-a-vis dollars, we have to pay more to import $1 worth of products. So why is rupee declining? Because there is capital outflow out of India. Foreign investors are getting out of India. This is putting pressure on rupee, and because of this pressure, everything that we import has become expensive. Make sense? Okay, so these are the major drivers. Now, remember what I told you in the beginning. Headline inflation, overall inflation, well, it is driven basically by food and fuel, overall inflation. Okay, and food and fuel are mostly driven by supply factors, shortage in supply. But there is another component of headline inflation, and that is core inflation. Now, the reason why RBI is panicking is because it's not just food and fuel inflation that are rising, it's even core inflation. And core inflation is driven by demand factors. That means demand is also rising, which is also kind of good news, okay, because that means people have more money, they are spending more, demand is rising. But it's also bad because it, pushes the overall inflation figures upwards. So this is the thing. Clear? Now, what should RBI do? Now, this kind of situation puts RBI in a dilemma of sorts. What should RBI do? RBI has this policy, okay, through its monetary policy committee. RBI can do two things. Either reduce repo rate. The purpose for that would be to boost India's GDP. Okay, if RBI wants to boost India's GDP, RBI would reduce repo rate, but it will have a side effect, and that is high inflation. So RBI cannot risk increasing inflation further because inflation is already high. So should RBI reduce repo rate to boost economy, but that will have a side effect. Okay. Now RBI thinks that, okay, I will target inflation. Let's lower inflation first and then look at GDP. So RBI will increase repo rate. Inflation would get under control, might get under control, but India's growth would also get sacrificed. So what should we do? Go for this or go for that? Okay, these are the two steps, options with RBI. Option A, reduce repo rate. Option B, either stay neutral, keep rates as it is, or increase them. Then also there is a problem. What should you do? This is a problem. Now, there are some way forwards that are suggested. Okay, to control food inflation, well, you can keep strategic buffers of food crops, okay, like pulses, wheat, rice. So whenever there is shortage of food, government can sell those buffers in the market. So this is there. Then boost your irrigation technologies or irrigation mechanisms, because monsoon is going to be problematic this time because of El Nino. So what you can do is you can basically boost irrigation methodologies so that even if there is shortage of rain, farmers are not suffering. And diversify your import or export sea trade. Don't completely depend on Strait of Hormuz. Look for alternative sea routes to ease supply chains. This can be a way forward. Right? Make sense? Okay. Now let's move on to next news item, and that is external sector and external rate management. Now remember, I told you that all these topics, all four topics of today are connected. Now, when we talk about the first topic, high inflation, CPI inflation, there was one factor that was behind high inflation, and that was imported inflation. And the reason why there is imported inflation, the reason is that rupee is declining vis-a-vis dollar. So this particular topic is related to the decline in rupee. So in this topic, we'll talk about why rupee is declining, okay, and what steps have been taken by government, both government and RBI, to arrest this decline, stop this decline, okay, and what future pressures are there on rupee. We'll talk about everything. Clear? This is really important if you really want to understand economics or exchange rate management. So let's talk about this. So external sector and exchange rate management. Now remember this one thing. Exchange rate management is the primary responsibility of RBI. Like inflation is the primary responsibility of RBI or RBI's committee, Monetary Policy Committee. Exchange rate management is also RBI's responsibility. So a major job or role that would be performed to arrest rupee's decline would be performed by RBI. Okay, so what is the context? The currency plummeted from approximately 90 to a record low of 97 within a 13-month window, within 1 year. This sharp drop prompted coordinated interventions during RBI's June 5, 2026 Monetary Policy Committee review, alongside structural policy statements by Ministry of Finance. And because of their joint efforts, Ministry of Finance and RBI, well, from 97, we have again reached 95. Okay, because of their efforts. Now, what happened? Let's talk about this. So, RBI's currency management doctrine. So, what is RBI's doctrine? Look, rupee declines because of two things. Number one, if you run trade deficit, very high trade deficit, or let's call it current account deficit, because trade deficit is part of current account deficit. Now, this deficit happens when your import bill is way more than your export bill. Okay, when your import bill is way more than your export bill, when you import a lot and export very little, there is very high trade deficit, current account deficit, rupee falls. Rupee will improve if the opposite is happening. There is trade surplus. The other reason for that is, well, if there is capital account deficit or there is capital outflow. Foreign investors who had invested money in India, they are taking that money out of India. So there is net outflow of money out of India. Okay, rupee falls even further. Clear? Now to reverse this, you need to encourage more and more foreign investors to invest in India so that rupee gains. These are the two things. Now here's the thing. The thing is that RBI, how does RBI manage all of this? Well, we follow, and we'll talk about this in detail when we'll cover economics. RBI follows managed floating system. Okay, what is managed floating? Dollar rupee exchange rate is driven by market forces. Market will decide everything. Import, export, capital outflow, inflow will decide everything. But if there is very problematic situation, if RBI says that we have not set a target as to what should be dollar to rupee ratio. We have not set a target, but we don't want unstable movement of rupee. Okay, so if rupee is declining way more than expected, too much in too short a time, that means extremely volatile, RBI starts selling dollars from its forex reserves. Okay, now remember I told you RBI doesn't want very high rupee or very low rupee. They just want stability. So if rupee is declining way too much, RBI starts selling dollars. And if rupee is gaining way too much, that is also not what RBI wants. Then RBI starts buying dollars and stores it in its forex reserves. This system is known as managed floating. Managed floating means that market will decide. But to curb extreme movement, extreme volatility, RBI will intervene by either selling dollars or buying dollars so as to arrest the decline or gain. Make sense? Okay, this is managed floating. Now, I told you about forex reserve. Forex reserves are managed by RBI. What is included in these forex reserves? Okay, so number one is foreign currency assets like dollar, pounds, all these. Then number two is gold. I'm writing this in decreasing order. Okay, in RBI's forex reserves, well, if RBI's forex reserve is somewhat around $600 billion, $500 billion comes from foreign currency assets, then around 100 billion from gold. Then special drawing rights, which are kept with IMF. And then reserve tranche position, which is also kept with IMF. These are very little in RBI's total forex reserve composition. Majority of forex reserves come from these two things. Clear, but you should know this. 4 items are basically, forex reserves consists of these 4 items. Make sense? Now, what did RBI do to curb rupee downfall? First of all, we liberalized government securities. Government securities are government bonds. We liberalized it so that more and more foreign investors can invest in government securities. They can invest it with ease. Plus, earlier they were not very enthusiastic about investing in government securities because of a lot of tax burden. Government reduced certain taxes, abolished certain taxes on government securities. Now, more and more foreign investors are encouraged to invest in government securities. So they are bringing capital into India, capital inflow. This is one reason. Then another way through which we allow foreign money to come to India is through NRI deposits. FCNRB is NRI deposits. We are offering very high interest rates in our banks so that more and more NRIs are doing their FD in India, fixed deposits in India. So this is bringing more money. Then compressing export realization window. What is export realization window? This means that look, when you export something, you receive payment in dollars. Okay. Now, earlier RBI used to say, or government used to say, that you receive these dollars and you convert them into rupees and then deposit it in a bank in India. This entire process you can do in 15 months. Now, RBI has reduced it. Government has reduced it to 9 months. Now, you have to quickly convert your dollars into rupees and deposit it in India. So, this basically has fastened payments that we are receiving for our exports. This has improved rupee. And then capping net open position. You see, sometimes banks buy dollars so that today they buy dollars at 80 rupees and tomorrow they'll sell it at 90 rupees. Okay, and will earn money through this capital gain. Now we have capped the gain that banks can have. Okay, we have capped it at $100 million per bank. Banks have a lot of dollars. Okay, now banks, after a point, they were forced to sell. Even if the rupee, even when rupee went to 90 rupees and they expected it to go to 95, banks were forced to sell it at 90. This led to more sales of dollars in the market, reducing the demand for dollars, thereby stabilizing rupee. Remember what RBI does. When rupee is declining, you sell dollars. This is there. Make sense? Now, these were the actions that were taken. But despite these actions, there are still some pressures on rupee. Rupee can decline further in future. What are those pressures? Number one, narrowing yield spread. Whenever the difference between US interest rates, for example, US interest rates are 4% and India's interest rates are 5%. You know, India's interest rate should be really high as compared to US so as to attract investors from US to India. If there is the gap between the two interest rates is very narrow, Indian investors would want to invest in safe countries like USA. Okay, so this leads to, when the gap is narrow, this leads to outflow. So this is a problem. Then most of our foreign investment is coming from FPI. FPI is very short-term money. Whenever things are good, they'll invest in India. As soon as things become bad, they get out of India. Okay, so India is vulnerable. We should rely more on foreign direct investment, which is more permanent. And then, well, the problem is, well, crude oil, Strait of Hormuz, West Asia. The crisis is still there. So rupee is still exposed. Clear? That's about it. Now let's quickly shift our focus to next news item, and that is capital gain tax exemption for G-Secs. Remember, we just discussed that there were certain steps taken by government and RBI to arrest decline in rupee. One step was liberalizing investment in government securities, right? So this news item is related to that. Government basically took a bunch of steps through which government securities became more popular among foreign investors, and that is why we are witnessing some investments, foreign investment in India, which has stabilized the rupee a little. So what were those steps with respect to government securities? Let's quickly talk about this. Remember, I told you everything is connected in today's lecture. This is there. So capital gain tax exemption for G-Secs. So what happened? In a coordinated policy move alongside Reserve Bank of India bi-monthly monetary review, the Union government notified an absolute capital gain tax exemption for foreign investors trading in government securities. Now for this, you need to understand what is capital gain tax. So if a foreign investor bought government securities for 100 rupees and now wants to sell it at 110 rupees. So this 10 rupee is called capital gain. Okay. And government charges a tax on this 10 rupee gain. We see this in property also. You bought a property for 2 crores and then sold it for 4 crores. Your capital gain was 2 crore and government would charge a tax on that. This is known as capital gains tax. Now this was applied on foreign investors investing in government securities. Now foreign investors are no longer interested in Indian government securities. So as to attract them, government has decided to exempt these foreign investors from giving this capital gains tax. Now they will save a lot of money on capital gains, and now they are attracted towards government securities because now they see a chance of earning more money on capital gains. So this is the thing. Now along with this, they have taken a lot of other steps also to make government securities attractive. So let's talk about those things. Okay. So core pillars of reform. To establish an attractive environment for foreign debt capital, basically they're loaning money to the government through government securities. Ministry of Finance combined this capital gains relief with another key tax reform. And what was that? Abolition of withholding tax. Now the foreign investors were not only required to pay capital gains tax, they were also required to pay taxes on the interest they earn when they loan money to the government through government securities, coupon rate or all these things. And that tax was collected at source only. So let's suppose they were earning rupees 10 as interest income on 100 rupee government securities. Government would charge a tax on it. Now government has abolished it. Plus, government has created this single window portal called Swagat FI. FI stands for foreign investors. Swagat means welcome. So this portal has made things easier for foreign investors to invest in India. So this is using digital governance to reduce red tape, paperwork. This is there. Okay. Now, what are going to be the benefits for this? Now, government is running a fiscal deficit. For that fiscal deficit, they had to borrow from India, from banks in India. Now, banks, if they are loaning most of their money to government, less would be available for private borrowers. This is known as crowding out. Now, government is borrowing from foreigners. So, Indian banks have enough money to loan out to private players. So, there is no crowding out. So, financing fiscal deficit without crowding out. Plus, more money would come. Currency would stabilize. Rupee would be defended. Yes. So, here is a table explaining the steps taken by the government. Okay. Pre-reforms, post-reforms. So, do take a look at this table. You'll understand this because we have discussed everything. Right. And now let's quickly shift our focus to next news item, and that is strategic macro shields. Now, this particular topic is basically a summary of the previous 3 topics. Now, India is suffering externally. The external environment for Indian economy is not at all great, not at all good. Now, what can India do to protect, to shield itself from this problematic external environment? Well, government of India can do certain things. They have done those certain things. Those certain things are called macro shields, shields against negative external environment, so as to protect yourself and keep on growing. Yes. Now let's discuss about these macro shields and the concept of macro shields as well. Okay, so let's talk about this. So strategic macro shields. In June 2026, Ministry of Finance articulated a structural shift in its fiscal management strategy, faced with the dual challenge of rising crude oil prices and surge in fertilizer subsidy. Because most of our fertilizers come through imports, and imports are becoming expensive. So market price of fertilizers is very high, but government promises farmers a fixed price. Now, if market price increases further, government subsidy bill also increases. This is creating fiscal challenges. Okay, so this is happening. The objective is to achieve fiscal deficit target of 4.3%. Now, this target can be achieved through 2 ways. Either you reduce your development expenditure and finance your subsidy bill, because fertilizer subsidy bill is rising. So where will that money come from? You will reduce your capital expenditure, infrastructure spending, capex. Now, if you'll do that, India's growth is compromised because this capex, this infrastructure spending is what is boosting India's growth. So government has found a way out through which it will not reduce its capex, but also find money to finance its subsidy bill so that its fiscal deficit target stays at 4.3%. Okay. Now, this macro shield strategy has two components. One component is more capital investment from foreigners. Okay. Capital framework and economic stabilization fund. So government has created an economic stabilization fund. What is this fund? Well, when times are good, government will put money in this ESF. Okay. When times are bad, government will use this money to finance its subsidy bill rather than reducing its development expenditure. So government has done this. Then government has increased its non-tax receipts, received more money from RBI, government PSUs. This has given government some cushion to fulfill its subsidy requirements. And subsidy shield, farm subsidies are funded not by debt but by surplus generated from ESF and higher tax collected. Okay. Then there is a component 2 also, and that is asset monetization. Government had launched national monetization pipeline. Under this, there were various government assets like airports, railway stations. All these assets were not working. They were left idle. Now, government has decided to lease them out to private players. Ownership is with the government, but it has leased them to private players in return for some money. That money will be used for paying off subsidy bill, and those assets would also function because private manages those assets efficiently. So this is component 2 of the strategy. Here, the other is disinvestment. Okay, disinvestment means selling government shares in various PSUs. So that is also generating money, and government is doing that strategically by selling some of its stakes in some government companies. Government is generating enough money to finance its subsidy bill. So this is third part of the strategy. Now, this entire macro shield framework of the government is given in the form of this table. Do take a look at this also. It is given in your notes, right? And that would be all. With that, we conclude today's session. So thank you so much for watching, everyone. And I hope you understood each and everything in this lecture. Now, certain things in these lectures can only be understood if you have covered economics once. For those of you who haven't done that, well, just listen to those concepts, okay? Stay patient. Once we'll cover economics, you'll understand all these things, complicated things as well. So don't worry, have some patience. And if you have any doubt, do ask that doubt. We are here to entertain all your doubts. We are waiting for those doubts. So do ask them proactively. All right then. With that, we conclude today's session. Thank you so much, everyone. And I shall see you with another lecture in this current affairs lecture series. That's a promise. So thank you, everyone.